The 2008 financial crisis was one of the most devastating economic events in modern history. It shook the global economy, wiped out trillions of dollars, and left millions unemployed. But how did it happen, and what can we learn from it? In this video, we'll take you through the history of the 2008 crisis, step by step. The story begins in the early 2000s. The housing market was booming in the United States. Banks were giving out home loans to almost anyone, even those with poor credit. These were called subprime mortgages. Why? Because the banks believed housing prices would always rise. Wall Street saw an opportunity. They bundled these risky mortgages into financial products called mortgage-backed securities. These were sold to investors as safe investments, despite their high risk. Big profits meant more and more risky loans. It became a ticking time bomb. Then came the Federal Reserve. After the dot-com bubble burst in the early 2000s, the Fed cut interest rates to stimulate the economy. This made borrowing cheap. People took out more loans, driving housing prices even higher. It looked like a win-win, until it wasn't. By 2006, cracks in the system started to show. Housing prices stopped rising and began to fall. Suddenly, many homeowners owed more on their mortgages than their homes were worth. This is called being underwater. In 2007, the ripple effects began. Banks realized that many of these loans would never be repaid. Investors panicked as mortgage-backed securities lost their value. The credit markets froze, making it difficult for businesses and consumers to borrow money. And then, in September 2008, the unthinkable happened. Lehman Brothers, one of the largest investment banks, declared bankruptcy. It was the largest bankruptcy in U.S. history and sent shockwaves through the financial system. The stock market plunged. Banks around the world faced insolvency. The crisis was now global. Governments and central banks scrambled to respond. The U.S. government launched the Troubled Asset Relief Program, TARP. This injected $700 billion into the banking system to stabilize it. The Federal Reserve slashed interest rates to near zero. Other countries followed with similar measures. But the damage was already done. The unemployment rate in the U.S. skyrocketed to 10%. Millions of homes were foreclosed. Entire industries, like construction and finance, collapsed. The effects were felt worldwide. So, what caused this crisis to spiral out of control? First, there was a lack of regulation. Banks and financial institutions were taking enormous risks without proper oversight. Second, the belief that housing prices always go up created a false sense of security. Third, complex financial products like derivatives made the system more fragile. The aftermath led to significant changes. In 2010, the U.S. passed the Dodd-Frank Act, introducing stricter regulations for banks. Stress tests became mandatory to ensure financial institutions could withstand future crises. Governments around the world pledged to never let this happen again. However, the legacy of the 2008 crisis is still with us. Many people lost their life savings and never fully recovered. Income inequality widened, and trust in financial institutions was deeply shaken. But it also taught us valuable lessons about risk, regulation, and economic resilience. The 2008 financial crisis was a wake-up call for the world. It showed how interconnected and fragile the global economy can be. Today, as we face new challenges, we must remember those lessons. Because history has a way of repeating itself. If you found this video informative, don't forget to like, subscribe, and share. Let's explore more financial history and learn how to build a better future. See you in the next video.